All right, guys. Noah Goldberg back on. Sharp guy. I've respected Noah especially because I think that he's full-time investor in the space, but has been one of the more pragmatic and balanced of the, yeah, let's just call it like, full-time professional investors. And so, yeah, I'm always happy to chat with him and hear his views. So we don't need to go into too much into your partner at Theia. What is your overview on the market right now?
Thanks for having me on. Yeah, I think I'll start with the Trump election and kind of work forward from there. I think that Trump got elected, that was naturally great for crypto. Opened up the ability to have regulation pass like Genius, which has had pretty big impact on stablecoin proliferation within TradFi. Albeit it's in the early innings, but you can see the benefits that Genius has had. Additionally, Clarity seems to be maybe passing. We'll see. I know poly market odds are low volume, but they say somewhere around 70%. I'd kind of put it at 50-50 without being particularly informed. And then you have exemptive reliefs that are coming from the SEC and a number of regulatory statements from the CFTC around different products within the kind of crypto finance space. So I think that's one big theme, is that the traditional financial system is adopting crypto, or kind of the aspects of crypto that you would expect, things that improve the underlying efficiency of their products and perhaps increase their margins. Simultaneously, I think that Trump has, you've seen the headlines. He and his family have made, $1 billion+ from crypto. And I'd suggest that a lot of that activity is somewhat nefarious. And so I think that crypto has also gotten a more negative reputation than it already had before his election. And then we also had kind of this wave of DATs that reminds me a lot of the SPAC mania, where when it's happening, a lot of people don't really think it makes that much sense, but they understand the game. And then after they all kind of fall down, then everybody has a bad taste in their mouth. And then that kind of wound up to 10-10, where there's a lot of leverage built in the system because DATs were pushing up price. And so people felt like there wasn't much downside. And then it all kind of collapsed together. And then it took a while for the bodies to form or float to the surface. And crypto prices kind of came down. And yeah, just to round it out where we're at today is I think that there are, on the fund side of things, and just in general, the larger capital providers in crypto, there's been no real inflows into the fund landscape for the past several years because 2021, everybody was overcapitalized. In returns, beta was good for 2023 and 2024. Everybody that was long the market should be up at least 50% annualized across both those years. I think 2025 was a rough year for funds because the S&P was up materially, but I think Bitcoin was down 10 to 15%, and I think ETH and Sol were down a bit more. And then now you've had a pretty large drawdown. And so I think there were some funds that went out of business towards the end of last year. A lot of them were the delta neutral funds that blew up in 10-10. But I think that there are a lot of fund managers that are kind of in a poor position. And so I expect that there will be more fund attrition. I think that sets up for an interesting opportunity, but I think the story of the market for the past several years has been just this digestion of 2021 and then regulatory changes and directions that have had various effects on the industry.
When you say funds, so you're alluding primarily to liquid funds in this scenario, right? That was my interpretation, and especially when you said up 50%. Obviously that would imply some actual mark to market there.
Yeah, I say liquid, or I'm mostly referring to liquid funds, but the same thing is true for venture, in that a lot of venture funds, let's look at the token venture funds. I know they don't delineate by this, but just on the token pipeline, which is the main way that venture funds historically have returned capital. If you look at the marginal TGE over the past couple of years, I think there's been some good reports on Binance TGEs 90 days later, they're down 80 to 90%. And so there's just no exit opportunity, and all these funds need to generate DPI in order to raise their marginal fund. And I speak to a lot of venture funds, everybody's in the market or has been in the market or wants to be in the market to raise their next fund. But the DPI across the entire cohort of the past several years is generally quite low. And so I think the liquid funds, I know the returns, and so I can say with more confidence how things are going to play out. But I don't think that the venture funds are all that different. I think that there's consolidation across the industry right now. And like there are a lot of subscale venture funds and funds in general that were playing for like high returns because that's the historical return profile of this industry. And the returns have compressed. And so what made sense is a subscale fund that could increase in size. If you don't have a positive view of the next few years, I think it's hard to kind of keep playing this game. So yeah, I would say like kind of the winners that you would expect from, or like the top quartile from the liquid fund or liquid directional fund and the venture fund industry, I think everybody's doing fine. But like anybody below the top quartile, I think is generally in a tough position. And the last thing I'll say is that we have less visibility into like the early stage side of the market. But from what I've heard, there aren't as many companies coming to market. So like there are a lot of venture funds, but there aren't a lot of projects to invest in. And so that's a pretty bad setup for venture funds businesses over the short to midterm. So to me, it just seems like the market is shrinking because there was too much capital supply and too little investable opportunities. And the growth stage rounds are still being done. Like there's a lot of growth in like the TradFi crypto side, but increasingly those deals are being done by non-crypto VCs. It's kind of like the traditional VCs that are getting into those deals. And so I just think it's like a tough environment for where like the crypto funds in general right now.
Yeah, I wanted to ask you about that actually, because this is a thought that I've had. I was talking to somebody recently about this, and I'm asking you this because I think you're very much you lean on the honest side of giving me a response here. So I'm just I'm interested to hear like, a pretty straightforward kind of answer to this. My thinking when I see a lot of this, a lot of funds are like proposing that they're now fintech funds, right? And almost is a very broad, intentionally nebulous description of what they do, and it's leaning very much towards fintech. And you hear people talking very much about fintech, right? And crypto rails with fintech, but it seems like the crypto aspect is sort of dwindling. My point in asking this is that I am curious what your thoughts are on a fund that was successful and known as a crypto fund with very, very different dynamics from investing in fintech equity, which Benchmark and Sequoia and the non-crypto side of Andreessen and Lightspeed and all of these funds have done for years now. Where do you think the edge is for a crypto traditionally token fund transitioning into fintech, right? Like, is this the same skill set? I hear this a lot now and I'm like, wait, that's not what you guys were prior. Why should I think that you have an edge in doing this now?
It's a good question. And I guess it depends on the exact focus and underwriting style of the fund and the transition that they're making. So for example, if you're like a seed stage crypto fund and your edge is sourcing deals, that doesn't translate to fintech. It's not to say that you can't like determine who's a high quality founder, but you don't necessarily have a fintech network. And I think in general, there's enough VCs in the fintech space. So I think like the edge on the early stage side is a function of your network, just because it's a lot more like founder oriented versus business oriented. Don't get me wrong. I think that people that understand crypto finance should be able to understand how to build like a comprehensive market model for what they're going to invest in the early stage. I think as you get into like growth stage and liquid token markets, it also depends, but on different dynamics. And that like, if you're a fundamental oriented fund, I recognize there are a few of them in the crypto space, but let's say you're building out cash flow models in late stage businesses. I don't think it's that big of a leap to move into fintech. I think we have to get into like the question of defining edge and like how much edge you need to move into this other market. So it's like, I believe that if you can underwrite the appropriate valuation for Aave, Hyperliquid, Morpho, whatever those like large cap tokens are based on some DCF, you should be able to create a DCF for these other businesses. The follow-up question is then like on edge, is building a DCF and properly valuing something based on like public information really going to give you a high return? Like the return profile in crypto is high because you have a large percent of the market that is not fundamentally oriented. And so you have volatility that moves prices outside of that fundamental valuation. Whereas in equities, I'd imagine that the dislocations from fundamentals are much narrower. And so I think that the game is harder in public equities. You have tougher competition. And in general, I think the market opportunity from a revenue perspective for funds is much higher. And so you have funds that are willing to spend a lot more on the cost side to have an edge. So I don't know, like the example that comes to mind that's easy for viewers to understand is how many funds in crypto are getting drone operators to like go outside of companies and see how many cars are coming into the companies and back into like the revenue that's going to be created quarterly. Like that is kind of one way to have an edge in public equities, and that's not the type of edge that funds in crypto have built. So it's all to say, I think it's possible. I think it's highly dependent on what your edge is in crypto based on the stage that you're playing in and the style of underwriting that you're doing. But in general, on the private market side, I don't think it's easy to build out a network to get access to deals if you weren't already in the market. And I think that crypto has like kind of a negative reputation. And so being known as the crypto fund that's now trying to do fintech is probably a hard position to have.
I think it also just, I guess it depends on how you define crypto versus fintech at this point, right? And like that merging of the two is such that it's probably not such a clear distinction. I just think it is kind of interesting to hear this term fintech so frequently now, when mostly fintech has been funded for decades now by very successful investors in the Valley across the world, right? And yeah, if it uses crypto rails, I suppose that, even that, what does that mean in practice? It's hard to know, right? Like I think almost every bank and institution now and startup is working on a stablecoin strategy if you listen to, what everyone says. So I'm not trying to delineate too much. I do find that interesting because mostly what these venture funds have been successful at is token investing, right? Like, and especially in terms of like the outsized asymmetric returns in the past have been from, multiples on these tokens. But the other thing I wanted, it kind of goes back to a point where you were talking about earlier with regards to how venture is doing and also liquid. You keep hearing this term that there's like a tremendous amount of token overhang, right? And like this seems functionally true, especially if you look at all of the launches, like you were saying, that are basically straight down. Like almost all of the big launches in the past 2 years have been straight down. There's still a lot of money tied up in those. So I'm curious, I think one way to look at it is that like none of that is real and all of those valuations are truly like monopoly money, but that doesn't bode particularly well, I don't think, for the industry at large, especially with regards to tokens. Like, so how do you view maybe a lot of these launches? Like, is it going to be straight down for a very, very long time? And how much does that impact a lot of these early stage investors who were plowing money into some of those deals? Like, and not just 2021, like last year, 2 years ago, we saw, massive infrastructure raises. Like, how does that set up some of these venture funds?
So I'll answer your question, then I'll give you kind of a longer rant.
Good.
But on the first part, it's nuanced depending on how we define token overhang. Because like when I think about token overhang, I'm thinking about what are all my liquid market opportunities that have vesting that still need to occur, and therefore like someone needs to rotate out of their existing position in order to hold the bag there as VC sell. And that token overhang isn't that large. Like I'm mostly segmenting towards like real businesses that have real value. So like companies that are making money in primarily DeFi. You have a few players that have, $50 to $100 million of unlocks still to process over the next year or two. But Hyperliquid is its own beast, and it's not venture, it's the team, and I don't know whether they're going to sell, but that's like the large token overhang that's not as concerning to me. I think the more concerning token overhang is the VCs that still need to sell because they're going to go out of business. And because prices have come down so much over the past few months, like the total dollar value of overhang is kind of low. I don't know if it's low enough where the existing liquid market can absorb it without prices going lower on the specific names that the overhang is taking place, but it's no longer a broad market risk in the way that it was 6 months ago. Like I remember I built out like a token unlock schedule for all the high quality DeFi projects, and it's like $1 billion+ a month.
You're talking about high quality DeFi projects. This is on the far end of the spectrum of value. Yeah, no, I'm saying what I. Okay. Sorry, go on.
But it's just to say, like, this is where I'm spending my time in the market, and this is what I see on like the stuff that actually I think has long-term value. We then get into like the tokens that launch on Binance that like have no bids, like no liquid funds are actually speaking to these teams. Like the teams aren't even trying. Like there are a lot of those tokens that are coming through Binance, but like they don't actually hit the radar of liquid token funds anymore. And maybe it's because I'm not speaking to liquid token funds as much as I used to, but I think in general people are coalescing on businesses that have value, and there's nobody that's willing to speculate without speaking to the team, understanding their legal rights, even if they're not trading based on fundamentals. Like the results have proven themselves out, and nobody's willing to just light money on fire. And then on the tokens that have yet to launch, I think I had a tweet about this, but it's just like if your business is going to die, do yourself the favor of not launching a token to find out whether you can save yourself. Just let the business die and move on. That's not to say people won't launch tokens. Like I'm seeing a lot of tokens get launched where it's like the token launch market is not in a good space right now. Like it was great to launch a token if you're timing things in Q3, Q4 of last year. But if you're launching a token right now, you're essentially telling the market that you're desperate in one form or another. So I just think like, yes, there are probably a lot of tokens that are sitting on venture fund balance sheets that are marked to, you know, their cost basis or maybe even marked up. But I just don't think that there are almost any that are in the pipeline that are going to have any bid from funds. Like this is my job. I look at all the tokens that launch, and there are occasionally tokens from teams that I haven't heard of that are interesting to speak to. But for the most part, like if there's a token that is backing a business of any like reasonable value, I am one of the only natural bidders left in the market that's willing to touch it. And I don't see too much coming into the pipeline. It's like maybe one a month, maybe one every couple months. So if you think there are 100 plus companies that need to launch a token, I'd imagine 90% plus of them are zeros. Unless, and like the last thing I'll say here is just on the early stage token side, like things are conforming a lot towards traditional venture valuations, and that like if you're doing 1 to 2 or like 1 to 5 million of ARR, you're trading at less than 10 times. So I think you just need to assume that for these Series A companies that are launching tokens, that they're going to trade at somewhere between like 20 to 50 million, which seems fair. Like we as token investors are taking legal risks owning these tokens, not owning equity. And the multiples that we're paying are not low, but they're not high either. And the business opportunity in today's market for a lot of like token-based companies is a bit unclear. And so like I think you could view them as small businesses that may become like $100 to $500 million companies, but there aren't that many that are launching the market that you could feasibly like make the argument on like a cash flow basis that they're going to be like $1 billion+ opportunities. And so to some extent, I think that like the market on the liquid side has corrected itself, whereas the venture side of the market has not had to really like look at the state of markets and figure out where do we go from there.
Yeah, you mentioned hype, which you said kind of is a beast unto itself. You had a very long and well thought out perspective on hype. Yeah, maybe we can start there.
Yeah, I'll preface by saying I think hype is one of, if not the highest quality company in token land today. And that's partially why my perspective is that it's probably overvalued, because I think the two things go hand in hand, and that like the majority of the capital in liquid markets is not valuation focused. It's like seeking quality or something qualitative, or is just seeking a narrative. And I think all of that lines up well with hype. Like they're doing a ton of revenue. The activity is organic. They have a lot of usage, primary market share in a market that has a fair amount of revenue available to it. There are comps in traditional markets for CFD brokers that trade at $10+ billion companies. I think there are a lot of things to like about hype. It's just you build out a DCF, and I think it's a hard bet to make. And I don't think that's like a controversial opinion. What I found interesting, not to like belittle anybody's analysis, but the comments that I was getting were people that were complaining about my analysis, but that don't actually do any fundamental analysis themselves or like build valuations. And they were just upset about me saying something negative about hype, which I think just tells you what's going on here, which is, you know, people hold the hype because there are a lot of like vibes associated with it that make sense. And it's not to say it can't go up, but it's not because the cash flow story is interesting.
Yeah.
15, 20 billion adjusted market cap. So like that's kind of like my very high level view on Hype. It's a great business. Everybody in crypto has plowed their capital into it, so it's a very crowded trade. And that's why I think it's probably overvalued, just because I think that there isn't anybody that's like really properly assessing the probabilities of failure in various degrees versus like everybody anchoring towards what is the success case. Let's drag right on HIP3 continuing to gain success. Let's talk about like HIP4, HIP5. And so we can paint this grandiose picture that like, if it's right, this is objectively a very low valuation for that outcome. But I think like my perspective, albeit as like somewhat uninformed, I just look at the history of finance as far as valuations, margins, etc., and say to myself, like, okay, this company is clearly over earning if history is going to hold true for the future. And the multiple that you should be willing to pay for this business can't be that high because its margins are going to be hard to defend in one form or another. And so like people can anchor themselves to this price to earnings ratio, but in reality, it's a price to sales ratio, and that has very different implications. And so, I mean, I'm happy to like
push that for a second. Just like in terms of price to sales versus PE in this scenario, what do you mean by that? Like with regards to revenue versus net income on Hype?
Yeah, it's the point is that like you can take two approaches. One is, oh, it's trading at 20 times earnings, and the other is, oh, it's trading at 20 times sales. Because essentially its sales are its earnings because the team's operating expenses are so low. I don't know exactly what they are, but I imagine it's like a 95 to 99% margin business. And so for 20 times earnings, putting aside the quality of earnings, that's not a hard multiple to defend. If you're growing your revenue by 10% for the next 5 years and then go down to like a GDP level growth rate, then 20 times earnings is the right multiple to be paying. But this is like an early stage company, so like it has much higher risk than like the traditional companies that you're ascribing a 20x multiple to. And two, like I have questions on quality of that revenue being generated, and we can get into that. And then I also have questions around the actual like long-term margins of this business. And so I would say if you look at 20 times sales and you compare it to all other businesses that trade above $1 billion to $2 billion of valuation, whether it's SaaS, whether it's fintech, whether it's like financials, this is the most aggressively valued company other than Palantir. That's not to say that it can't be true, but it's just to say the market's pricing in a ton of upside. And so you need to be like very correct on that upside.
When you say questioning some of the quality of earnings, what goes into that?
I think that the Hype wealth effect from the airdrop is probably the biggest wealth effect that's ever occurred from an airdrop in crypto. I think much larger than Uniswap, but also like the activity is siloed within itself. When you get an airdrop from a project that you just need to connect your MetaMask to and sign a transaction, it's not to say that you're going to be loyal to that product with the capital that you receive. But like when you get a Hype airdrop on the Hype platform and you have to actually like withdraw it, there is this implicit switching cost. Now, given the friction is low, but it's all to say where I'm going with this is that if you just look at like the billions of dollars that traders on the platform were given in 2020 or late 2024 and kind of drag right on how profitable are these traders, how frequently are they trading, it takes a year plus to like actually get them all to lose their money. Like if I gave everybody, like if I, not to like be overly negative, but like let's say I gave $1 billion to like 1,000 gambling addicts and sold them like you have to use this platform, I'm sure that platform would generate a lot of activity. Now given I'm being punitive relative to like what's actually going on, the traders are probably not as negative EV as I expect and all these other things. But like when you look at capital on platform, there's about 4 billion. When you look at annual revenue on the platform, there's anywhere from 500 million to billion. And I think it's reasonable to ask yourself, how is that possible? Like as a long-term equilibrium, is it the case that like people actually have a ton of capital that they don't hold on the platform? They rotate it into the platform, they trade, and then they take it back out? Or is it the case that the users on the platform are like hemorrhaging cash at very high levels, even like relative to sports gambling platforms? Yeah. And so this is the game that has to like be assessed.
Yeah, I think the very obvious and sort of trite counter at this point is that perps are going to take over everything. So that is you can have in effect at one of these, massive wealth creation events. And you're right. The gamblers lose their money back in the casino. I don't think anybody's denying that is occurring, at least in some capacity. There is durability though, right? Beyond what we've seen with virtually any airdrop wealth creation event. So that's one thing that I would very much defend hype on, is that there has been, you compare this to DYDX and more recently even, lighter, we'll see how that plays out. But I'm just, in terms of continuation of activity, I think hype is proven itself. So I guess the idea is that you shift from this degenerate group of people, gradually bleeding out their wealth creation event. And as the price goes up, they have slightly more to lose. So maybe it takes longer. None of this is lost upon me. But the counterpoint is the world is going to be perpified. Now, that is somewhat of a audacious thesis, by itself. But if you believe that, then it's reasonable to think that, hype, or maybe not hype, but perps in general, take X percentage of 0 days, take X percentage of retail traders on Robinhood, right? So I do think there is, if you view the trajectory of crypto in a certain way, or maybe specifically trading here, right, then you can very much make up for these dwindling slot machine pullers with the trading of commodities during the Iran, bombing, right? Maybe we're
for sure. Sorry, go ahead.
No. That was, I was just providing at least what, it's
no, I completely agree. I'm expressing the negative view only because I think the positive view is so well understood. And I'm fully aligned with it. I think it's just let's say you believe perps are going to continue to proliferate. Let's say that Hyperliquid could add additional HIPs that expand its market opportunity to other types of trading activity. These things all are reasonable. The question is just what's the competitive reaction function and how do margins change as these things occur? And my view is that with very high confidence, you will have either margin compression, you will either have take rate compression, or you have a combination of the both. Just because when a company is earning $500 million plus a year after spending, I don't know, 10 whatever million dollars to build the exchange itself,
people are going to want to do that.
Yeah. And so I'm not surprised that you had all of these copycat perp dexes come out after Hyperliquid's success. And I'm also not surprised that Hyperliquid has maintained its market share. Hyperliquid is one of the best examples of counter positioning in crypto. It didn't take VC capital. It built a loyal user base of the 10 to 20,000 true whales in this market. And they are loyal. And although some of them are going to lose their money, a bunch of them are the cockroaches that can continue to stay in the market. And so I don't doubt that Hyperliquid is in a great position. And I just question what that's worth. There are a very small number of employees. You have key man risk. You have questions on how do you scale up this organization? You probably have regulatory questions as far as I know that they've created this Hyperliquid policy center. How much capital are they going to have to use to get this regulation to move in a direction that allows Hyperliquid to exist in its current form? And if the regulation occurs that allows Hyperliquid to exist in its current form, what does that mean for its competition? Does that mean that TradFi can come in and compete?
Right. And that's what I was going to ask you about next. How do you see that? Because, again, this isn't strictly perps, but for example, Coinbase is trading at 40 to 50 times earnings. And there are now, like you said in your post very eloquently, you have to assess sort of the downside. You have to really assess the expected value there, because there's a lot more, failure modes in something like Hyperliquid, an early stage startup, versus something like Coinbase that is very established and has some real kind of entrenched moats, particularly in the United States, that are pretty difficult to supplant. On ramps, off ramps, they have egregious fees on the front end that 50 to 75% of retail seem to completely ignore. So what do you think with regards to, okay, Robinhood can launch perps. Coinbase has tried, they have some sort of, version of this, but yeah, what do you think of the invitation to competition? Maybe on a positive note, you could also mention, how does Hyperliquid defend this? Can they just be no KYC and that be, the selling point, for example? and capital moves to where it's most frictionless and point proven. I'll just end on one thing, and I'm not like a hype. I'm neutral on this. Okay, for one thing about hype outside of all of this is that it's kind of inspiring maybe that Hyperliquid seems to be one of the very few examples of, can a startup supplant incumbents? Like, can we take on Wall Street? Because we've said we're taking on Wall Street for a very long time, and we're really not. And Wall Street's really just like gonna pick and choose, and they'll probably end up making a lot of the money with these. So there's something kind of, almost visionary or ideological about supporting maybe something that could take on NASDAQ. And whether or not it like falls, like trading perps aligns with my ideology, I don't know. Like, I don't know that I care that much about that, but it's some evidence that, yeah, like you can supplant these financial firms that have been in existence for hundreds of years. Okay, so go ahead.
So, I mean, I think this is the tricky part, and also what influences my confidence and my view on valuation, which is that there isn't an obvious negative catalyst. Like, there could be 1,000 different negative catalysts, but none of them are obvious today. And that's why I don't think the market like cares that much about my like long-term, potentially like more neutral view versus how it's currently being priced. So like that's like one piece. But yeah, as far as the competitive dynamics at play, I mean, a part of it is a function of how does regulatory move forward. Like, they probably do need no KYC in order to compete. I'm open to that not being true, but that's like one initial impression that I have about the product, is that their existing users would be less inclined to use the product if it had KYC associated with it. Like, don't get me wrong, I think that like there is a reason why people use Hyperliquid and not Binance. And even if Hyperliquid had KYC, they'd still use Hyperliquid because they have a negative view of Binance and don't want to take the custody risk. But like there are just questions on like, you are letting people trade, derivatives on traditional assets that have historically fallen within the CFTC's purview, and they've taken a very strong indirect view on whether this is legal or not. And like, given regulation is shifting, and so it may move in a direction that allow these activities to occur. But like, I do think we have to accept that like the past, all financial history, these activities on like the HIP3 perps would otherwise have invited some type of enforcement action. So yeah, if we're moving to a different market environment, I think like there's the regulatory component initially about Hyperliquid, which like gave them the initial network effects, go to market. And now we have a question of how do you advance outside of the like 60K daily active users. And I think that like you have to go into the traditional markets, and then we get into the question of like what to the average people that are trading on Robinhood care about. And like, to some extent, I think that they want to use a regulated brokerage that they have like brand value associated with. That's not to say that like you can't have these like builder code oriented like mobile apps and other like UIs that obfuscate what's going on in the back end using like a decentralized protocol. But ultimately, like there is a form factor question of like, how do you increase the number of users on the platform that aren't crypto native? Because I think Hyperliquid has done a great job capturing all the crypto native users. But like to go to the next level, you're competing against the incumbents that have chosen not to go into the market that you're currently offering, partially because of regulatory, partially because they're focused on other things. And I just think like if, for example, Robinhood started to see that its user base was churning and they were churning to Hyperliquid, there would be some type of competitive response function. Now we can argue like how good that competitive response function would be, but it's just to say all the marginal users that Hyperliquid wants to attract are coming from other platforms that are either indirectly or directly competitive with Hyperliquid. And so they're going to become very defensive if, Hyperliquid continues to grow its user base. Yeah, but this is just like one microcosm of what could happen. But that's kind of my point, is that if you kind of play out all these potential scenarios, you have a number of scenarios where Hyperliquid is $100 billion+ company, and then you have a number of scenarios where Hyperliquid is in its current form. It looks kind of like a CFD brokerage, in which case it probably trades at like $5 to $10 billion and like, low teens to high teens earnings multiples. And then you have a number of scenarios where like Hyperliquid peters out over the next like 5 years and fades into irrelevance. I don't know. I don't think that like I'm ascribing unreasonable probabilities to the different scenarios. I just think that like the market is saying what is probably a 5 to 10% outcome is like a 25 to 50% outcome, as far as like Hyperliquid being a 50 to $100 billion company. And like, I'm happy to be wrong. I'm not short. Yeah.
I think a lot of that delta can be explained by the lack of other investable projects. Like, that's what's crazy about this industry from my perspective. It's just like, you get it. We've had this era of massive speculative premium, which is, I mean, still exists to this day, and it will take a very long time to bleed out. But we also now have this over indexing, right? And maybe it's justified, to be fair, right? Like, if crypto is the future, then maybe it's very justified. But we have this over indexing, and you say like consensus trade. This is exactly what's occurring. I mean, in practice, it's like, it's a less maybe even about hype and all of these like well thought through, assigning probabilities, scenarios that you kind of discuss, and more just, okay, where do we deploy our capital if a large portion of our mandate, for example, with liquid funds, maybe the liquid side of venture funds is in tokens, right? And it's like, well, hype makes money, and that alone right there adds some multiple. So, and hype can be accessed by people around the world. I mean, most of the rich people are in first world countries. So like, this is something that crypto has seemingly failed to realize for quite some time. So these people probably have the ability to buy this, but it is something that trades, permissionlessly. And maybe there's some fund in North Korea that, wants to buy Hyperliquid that can't buy, whatever. So yeah,
I agree. I mean, but and this is why, like, when you look at my exact Twitter post that sparked this conversation, I explicitly outlined from a cash flow valuation perspective, because I think like I don't want to get into the question of like what percent of the market cares about cash flow. But like, yeah, the most likely answer as to why Hyperliquid trades the way it does is not because the market is over indexing on the like right tail distributions. Like, I think they have to, because the price is the way that it is. But as far as what's happening, it's just, I have some amount of capital in crypto. I need to allocate it. And Hyperliquid is one of the top quality projects. And in general, I think that's what you're seeing across the board right now, where like the market has moved heavily from speculative assets and optionality to just indexing towards what is going to survive the next 2 to 3 years. And that makes sense, just because when you look at the KPIs in crypto today, they're not moving up right now on most metrics. And so I don't think that like there's much of a game in the market today on playing like quarterlies. Like, will this company inflect its KPIs over the next 3 months? Because KPIs aren't really inflecting right now. And so you're playing this game of who is going to continue to compound their network effects, who's going to continue to build products. And when KPIs potentially inflect in 6, 12 months, whatever it might be, who is going to capture that? And those players are all kind of well understood. Like, all the funds speak to the teams. They know like stack ranking, who's high quality, who's not. Like, Jeff is an incredibly strong founder. There's no doubt about it. And so it's a great story. I mean, I'd put, not to get into long spiel, but like I'd put something like Morpho in the same category, where like today it is not producing any revenue. There are a number of ways that it can produce revenue in the future. It is winning a lot of integrations and partnerships that may seed the possibility of it making a lot of money in the future. And it trades at a $2 billion valuation. Now, if you look at like $2 billion valuations in fintech broadly, all of the companies are a lot more mature, have a lot more mature revenue and margin profiles. Maybe they have less growth in the future, but it's just to say like the market is on a fundamental basis pricing Morpho incredibly aggressively relative to fintech comps. And like maybe it's justified, but I don't think it's because people are building out valuation models and predicting like 3+ years in the future, like what percent of the revenue gets split to its Morpho, et cetera, et cetera. I think it is, I feel pretty confident that Morpho is going to be one of the two, if not the number one player in a category that I think has a very large outcome associated with it. So I think it's all kind of the same thing happening in the market right now, which is there are a bunch of liquid funds. It's easier to kind of hold high quality stuff in this market environment than try to like take a punt on a lower liquidity token that may or may not work, just because everybody's trying to avoid downside.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers. Why do you think that Morpho, I guess you're talking about lending, I don't know if you're talking about Vault specifically, but yeah, just like maybe the broader lending landscape. Why do you think that is a massive, or has a potential? Did you write a post about this? I can't recall if that was you.
Yes, I did.
Yeah, okay. So go ahead. I read it.
Yeah, I think on-chain lending is a big market opportunity, but I think in general, fintech lending is a big market opportunity. I think that like our view on financial markets in general, our IFS thesis is just a lot of finance is antiquated and technology will improve the market structure. And so when you think about like what are the most obvious places to go after, it's the 3% credit card fee and the 1 to 3.5% NIM across most borrow lend activities. And like in some cases,
what borrow lend talk to me about, like, I don't know, I was going to say 5 years out, but just talk to me about where that borrow lend comes from. I guess, yeah, I mean, like, I think I've had evolving thoughts on this, but is this competing against margin loans on Schwab? Is this competing against mortgages? Is this like a prime broker type lending for trading firms? Where is that lending gap now, or why do you see it growing massively?
So I think there's like the crypto specific, the like Morpho versus Aave versus like other players specific dynamics. And there's a lot to touch on, but at a high level, I think that like the underlying credit market in the US is a lot more fragmented than equities and like other traditional securities because the credit itself is not standardized. There are standardized credits like public market bonds, but in general, like the public market bond market was trading on like talk trade and Bloomberg chats for a long time. And only now we're seeing market access and TradeWeb start to electronify all the aspects of like trading sovereign bonds and rates and things of that nature. And so it's just in general, like credit is from a technological perspective, much more antiquated than more traditional securities and things that were easy to electronify and speed up the process of trading. It's like, I know I'm starting at a very high level, but I think it's important. And then like when you look at post 2008, you went from banks funding a lot of like nuanced loans to it being pushed to private credit, partially due to the response function to GFC and capital requirements at banks, making some of this activity not particularly profitable for them. And so, private credit filled the gap on a lot of different parts of the market. I think I have questions on like the returns that private credit is going to generate on its current loan portfolio. And that partially plays into that, in that like I think that we're going to move to a more capital constrained society. And so people are going to have to find liquidity wherever it may lay. But it's just to say like private credit filled the gap in certain areas, but then fintech credit started to come in to fill the gap in other areas. Like, for example, you have prime borrowers that are able to use their like traditional credit scores to access loans. But then you have borrowers that like otherwise could be considered prime, but don't have the required credit scores. They have alt data that proves that they're prime. And those customers can't go through the traditional credit markets to access that credit. They're subject to going towards like a fintech credit lender that has some like alt data set that it's building an AI model on and is willing to issue credit. And then the last part before I get into the specific side of things is there are a lot of smaller loan sizes that historically have been too expensive to originate, and so that they just don't occur. And that's what Figure has done quite well. They've gone after HELOCs in the sub 100K loan category, where it's just unprofitable to originate. And so because the cost of their origination platform is 700 versus 11,000 from the traditional players, it's opened up that part of the market. And so I just think in general, like the technological aspects of the credit markets are continuing to have positive impacts on the markets, but I still think that it's in the early to mid innings. And so I think that there's ways to standardize a lot of credit. And ultimately, I see like a exchange infrastructure being the layer necessary. I think you need a standards layer, and then I also think you need exchange infrastructure to allow all these things to trade. Whereas today, it's kind of like RFQs that TradeWeb and Market Access have combined all under the hood. They have like their dealer networks. It's quite complex. And so that's the role ultimately that I see like the Morphos and other infrastructure players taking. And middleware is a tough market to like play. When you look at traditional fintech credit, a lot of the fintech players are doing some origination. And so like they own more of the stack, and therefore like they have a higher NIM, and it allows them to create a business that has a decent like cash flow profile. Whereas for Morpho, et cetera, like Morpho is currently not monetizing. They need to get network effects in order to have the ability to insert some type of rate. But it is a question, like, is this a market that like I could feasibly take some portion of interest, or am I going to have to like do a subscription model? And if it's a subscription model where I'm saying like Apollo, in order to access my platform, you're going to pay like 10K a month, like that's not a big market opportunity. So like there are some questions, but the point is that I think that one of many aspects of credit that is antiquated that can be solved via DLT is like collateral management. Like when you saw First Credit blow up, like one of the big issues that they had was just like they had collateral pledged to multiple loans, and nobody actually knew that this was occurring. Now, given that's fraud, but the point is like this activity in theory would not occur on a blockchain. And so I think where I'm going with this is that like someone has to take custody of collateral. That collateral needs to be accessible or at least checked against. And like the qualified custodians are one aspect of crypto that can solve this. You could have some type of smart contract infrastructure that allows for non-custodial collateral being held. And in general, like these complexities that have occurred in traditional finance have been solved via intermediaries that have just added on fees. Like you have security trust agents involved in this process in order to make it so that like the prime broker is, if they go under, does not impact the collateral that their customers are pledging to them. But they're all stopgap solutions essentially. And like one of the benefits of credit versus like trading for blockchain specific rails is that latency isn't really that critical. Like the latency of relevance is like T+1, not like 200 milliseconds versus 12 seconds. And so like I think you have to squint, like just coming full circle. I think you have to squint and say like, okay, how do we go from the current market structure to a market structure where like these things are infrastructure layers for like 100+ billions of loans? But ultimately that's the vision. And so like the next step here is you add term loans, you add much more complexity to the types of loans that can be originated, and you create peer-to-peer credit marketplaces. I think these are all the things that like Morpho V2 is published or is putting out to the market next. And then like that's going to lead to some marginal credit creation, and then you're going to figure out what are the next things to add from there. But ultimately, I think the idea is with global markets, the cost of capital is going to be lower than having an auction take place between a bunch of funds. And so that's why I think this thing works at the end of the day. And like, again, it's subject to probabilities. Like I'm not saying like 90% plus chance these things all become like massive global infrastructure, but if they do work, I do think that there is a $10+ billion outcome. And so, you know, you have to ask like, what's the multiple on your investment that you want to play for this outcome, given the uncertainty. But I understand how it's going to occur. And like, I see the seeds on issues in private credit markets that are starting to force capital to be more constrained. I see like the on-chain interest rates be sufficiently low where like there is free money to be had from originators that have like marginal assets. And like I see, for example, on Reg T margin, where Robinhood, et cetera, other than interactive brokers, are charging like Sofr plus 700, whereas like I'm very confident that you can find Sofr. Yeah, for like margin products, if you look at like the margin rate across like Schwab, across pretty much any.
What is Sofr?
Oh, sorry, it's just like the risk-free rate.
No. I mean, what is it right now? Because I don't. Like, are you talking about just like? Yeah, but Robinhood's charging like 3.75%.
Okay, I mean, maybe if you like Robinhood Gold.
Yeah.
I haven't looked at this in like a few months, but like when
Dude, it's pretty low. I'll be well. I know this. Yeah, it's like 3.5 or I mean, I guess it depends on how much you borrow, right? So like the lower the amount, but yeah, it's not. It's Robinhood's pretty competitive, and they pay like 3.5% on idle cash. So I just,
okay.
I'm not,
Yeah,
I'm not,
I mean,
I'm not.
that's fair.
Yeah,
I'm not trying to like say something that isn't true, but like let's say Schwab, for example. And the reason people are willing to pay 10 to 13% on margin for Schwab is because like you're a capped customer. Whereas like with crypto platforms, like ultimately anybody has the ability to just go in, deposit their collateral in a programmatic way and then borrow on
right.
terms. So I just think it's like this is a way to get the markets to be more efficient, and like credit in general is somewhat inefficient just based on the market structure relative to like traditional equities or other instruments. So I guess that's just
it's kind of interesting to hear you say that. Well, I've also envisioned it like this, but it seems that what you're kind of implying with this middleware, not analogy, but I guess description, is that Morpho will provide like, I'm using Morpho as an example. Morpho will provide like a very, very large pool of capital whereby the companies that do interact with the end user will be able to source capital. And that's the relationship there with, because the reason I say this is because over collateralized lending, I think has been, in general, by crypto has been kind of misunderstood. And I remember this. Yeah. So like, I don't know, you probably saw this a few years ago. People would talk about how a loan on Aave or Maker or whatever is functionally the same as a line of credit on a credit card or like a mortgage, because you are collateralizing something, right? Just in the case of a mortgage or a line of credit with, I don't know, Visa or something, it's your credit score. And then in the case of a mortgage, obviously your house. This is not precisely true, right? Like over collateralized lending is distinct from this. When you go to a bank for a mortgage, they are assessing like your credit worthiness, they're looking at your credit score, they're looking at your assets, and then they are mostly looking at, okay, do you generate enough income on a monthly basis to service this loan, right? And that is different than putting in 10 Bitcoin in Aave and borrowing, $500,000 against it, right? Like it's like, but this kind of this attempt to kind of blur these lines. But now I think what you're saying is much more palatable in terms of this acting as middleware, right, for maybe mortgages or lines of credit or something like that to interface with the end user or the end trading firm or the end institution, right?
I mean, that's basically what Figure's done. Like,
right. Yeah.
Morpho and these other players still have to do it. But,
right.
Figure has 300 originators on the platform. They're selling off loans that originate on the platform via an auction on the underlying exchange. I mean, I have questions as to like, do you need distributed ledger technology to do this?
Thank you.
but the point is that like this is the direction that credit is like going with very high confidence. And like to your point, on one hand, I'm optimistic about on-chain credit. On the other hand, I am quite frustrated with the speed at which teams have been iterating on product design, and that like 2021 look the same as what these credit protocols look like today. Yeah, not to speak about anyone in particular, but like the over collateralized peer-to-pool utilization-based interest rate model. That's what we have today. That was created much before 2021, but like the versions that are being used today are the ones that were created in 2021. And so like on one hand, I'm optimistic. On the other hand, I look at fintech credit players in the traditional markets and see kind of how fast they're iterating and the products they're building. And it makes me concerned for like the speed at which these companies that are like participating in crypto are moving at. But like that's the only other dynamic that I'd share, which is like I'm optimistic on this general theme. I think that like this is a competition, and ultimately the competition is not like Aave versus Morpho. I think it is in the context of who has share on chain and who's like playing for this like $200 million revenue opportunity of over collateralized margin loans against crypto assets. But that's just not an interesting game to play. It's a game that like sustains the revenue to be used to then build something big. But yeah, we definitely need to see it proliferate in order to place like a high probability on it to like make it impactful as to whether we're going to buy a company based on it. So I have my bullish views, and like it's more of like a long-term view, but as far as like how we act on that in the fund, it's a bit less forward looking. But I think you have to have this type of bias in order to understand why things trade the way that they do and why those things might be correctly priced. If you don't have this bias, then they're obviously overvalued.
No, I like the thesis. I think it makes sense to me. Like I we'll see. But one note, I mean, you kind of said this, but like one note on the speed of iteration is like that does to me indicate it's a little bit, I don't know, saddening. I don't think that's the right word, but it does kind of indicate the degree to which crypto is siloed and what lending is used for. I mean, they're like, why hasn't, Aave, or I don't want to throw anybody under the bus, but like, why haven't these products iterated? Well, it's because 90% of users are using them to borrow against the stuff they already have and then go and loop it 1,000 times or, play Ponzi games everywhere. So like that, there's been no demand for, can you finance this house of this brownstone I'd like to buy in New York, and you guys are the middleware for this. That's not what crypto people are doing, right? So like I understand, you know what I mean? But anyways, to your point, I see just an aggregation of capital and a lower cost of capital on chain. As we see now, it's wild the rates that people are willing to accept on these platforms for lending dollars. It kind of bewilders me, actually. But the point being, yeah, it does seem like, you can have a lower cost to borrow. And if that's aggregated, surely there's some efficiencies there.
Just one last point on this. Yeah. Like the green shoots and like why I wrote this article and decided to release it. Other than like the market's getting so pessimistic that I feel like I have to be the one that's optimistic now, which is a big change since the last 4 years. But the other thing is like, and again, to your point, a lot of it is looping and like lower or like less interesting activities. But if you look at the percent of tokenized assets that act as collateral on these lending platforms, it's increasing at a pretty high rate. Like Camino, for example, I think more than half of the collateral asset base on the platform is tokenized assets. A lot of it is Prime, which is like a warehouse for HELOCs. But I mean, that's a valid product. It's earning 8%. Those HELOCs are somewhat low risk, just based on my understanding of Figure's underwriting standards. And so if Figure is able to source marginal demand for their capital base and they don't have to go to a bank to get a line of credit, and this is like slightly cheaper, then I mean, I think that is showing what could be. But yeah, there are a lot of questions. I think like we need to add KYC. I think we need to add this legal layer. I think that it's good that we've gotten tri-party agreements with custodians that are hooked up into these protocols, because I think that's probably necessary. But yeah, there's a lot of more work to do. And I think like
what is Camino making on that partnership there? Like, what is their take rate there?
They have it by market. They have like a take rate on interest generated. And so I don't know what it is on Prime, but it's most likely about 10%. And so if like people that are borrowing against Prime are paying 6% on their 8% yielding asset, then Camino is making 60 bips. Yeah. So it's probably like a few $1 million annualized just on the Prime market. So it's not like a massive amount, but it's just to say like we are transitioning
proof of concept. Yeah.
Yes, we are. We definitely have some pilots and proof of concepts, and I think we'll continue to see them. Like I have decent insight into like the pipeline of tokenized assets coming on chain, and it is encouraging. Like I think there's still a lot of work to do on like the legal structuring. Like a lot of the issues that I have today is that everybody's building for a permissionless, and like there's no way to like confer legal rights in a permissionless manner, and so you then have these tokens that like represent assets but don't actually represent ownership in the asset. And so then like if I want to own them, I'm going to go to the company and like get an actual legal agreement between us before I like buy the asset. So it kind of defeats the purpose. But I think this is all a function of like people trying to build for the existing non-KYC market. Whereas like if you add KYC and you add the legal tech where like if I deposit, I have to sign a form, that issue goes away. And then you actually have the ability to have legal recourse just by owning the underlying asset. So I think like there are, marginal developments that need to take place, but I am encouraged. But I think the issues that I see today is that like some of the activity is still building towards a world that is slowly becoming less relevant as opposed to the world that likely will become more relevant.
That makes sense. Okay. So I remember Felipe's, and I don't know when this was, but there's like this piece that's subsequently been passed around quite a bit. It's like internet It was like the precursor to internet capital markets, or it was like one of the inspirations for internet capital markets, like internet finance. And yeah, I remember like I had a discussion with him at the time. So it like seems quite inspiring, I suppose. You're the cynical partner in the firm, so that's why I have you on instead of him to give us a bunch of, you know, utopia. But okay, one aspect of this is early stage financing of companies. You guys have since taken a position in MetaDAO. I see Felipe talk a lot about MetaDAO. Talk to me about maybe just this vertical specifically, early stage, very early, pre anything stage financing for companies. And yeah, we just maybe start there. I have more questions, but obviously MetaDAO being the inspiration for this question.
So I'm definitely not an expert on early stage financing. I think like there are a couple caveats that I'll initially give. One is like I have questions, if not doubts, around like early stage companies being public, because I think it adds like a lot more complexity than it's potentially worth in many cases. So like let me just preface with that. Yeah, because I think that's like probably gonna be the largest pushback to like MetaDAO is just, does this fundamentally make sense for helping people raise capital? But again, I think it gets into like global markets and accessibility to liquidity. And so I think like the way that we got to MetaDAO, outside of our view of the team, which I mean we're very happy with Profit and Cole and think they're doing a great job, is that we are token investors and token market has a lot of issues. And one of the issues that we see is on the legal and ownership rights. And like this may be solved by tokenized equity or changes in regulation, but that has to be seen. And so today I think we need like a stopgap measure. And there are a lot of like initial things that can be added to reduce the risks of like being rugged to token holders. And so MetaDAO is essentially trying to solve this problem. And that's why we're excited, because we recognize how large a problem it is for us and a lot of other funds that we speak to. And so like, for example, just like having an allowance on the treasury and for like a team that raises millions of dollars, where every month they are not able to just pull the entire treasury out and run away. They're forced to have a certain amount of money that they can access. And if they want more money, they can put up like a vote. That is one way to reduce the cost of capital for capital providers. You know, you have this futarcy mechanism on top, which, I mean, it's complicated and it definitely causes difficulties with telling the MetaDAO story from first principles. But the goal of the futarcy mechanism is just to enforce that the decisions that are being made for a company, the North Star is just the value of the company is going up by those decisions, and futarcy is the way that they're enforced. And that makes sense as an objective function. I think like there's naturally tail cases with that objective function. I acknowledge it. I'd rather not like spend too much of the time there. But yeah, at least today, I think that the early stage venture funding market has been capital abundant, and therefore you don't have this capital constraint that then forces people to find ways to finance themselves. But we're definitely moving towards a more capital constrained market. Like I just see it on the venture fund side, like people are going out of business. Maybe that means there will be less companies that want to raise capital, but more likely it means that there will be more companies that are unable to raise capital. And so then they're going to seek a way to raise capital, build their business. And MetaDAO is going to be one of those sources for people to raise capital. It comes with its own set of trade-offs, but ultimately it is an opportunity for a company that wants to raise capital to do so in a slightly more convenient manner than trying to raise from venture funds. And like the two examples I'll give is like one, emerging market founders that are not based in the US or like based in jurisdictions that don't have vibrant venture ecosystems. That's like one area that you're going to have founders from. And then the other is founders that are building something where they need like an initial cohort of users and see the value of like the reflexivity that comes from launching a token. And the example I'll give there is Avici. Like, without getting into the details on Avicii's market positioning, they are an on-chain neobank, kind of similar to EtherFi. They have a credit card attached to a stablecoin wallet. And they got their first 1,000 or so daily actives from launching their token, which created a discovery function for the market. And then that got people to use their product. And without that, I'm not sure whether they would have gotten the initial early users to kind of build from there. And so I think MetaDAO is subject to adverse selection in its earliest form because like there are questions on mechanism. there are alternative ones of fundraising, like all these different reasons that adverse selection is almost a guarantee for the platform. But as long as it has good use cases, like there are occasionally teams that are high quality that use it, and those teams have good outcomes, and the bad outcomes that come from teams that use it in a nefarious capacity is limited from the underlying mechanism design, I think that it's a good way for natural selection to take place within the venture markets. And that, like, if you had like 1,000 teams all launch on MetaDAO, I'd imagine that 50% plus are going to get liquidated over a few month period. And I'd imagine the 50% that don't are in general higher quality businesses, ones that do. And so then becomes a question of like, is it worth people's time to play this game? And I think given the state of the current token markets today, it is, but mostly because of how bad token markets have become as far as like the rug risk of investing in tokens. Like we deal with it every day. And at this point, like we have our companies sign legal contracts with us to make material representations. And like we also try to get them to make statements publicly similar to Morpho. But even that isn't necessarily enough in many cases. And so I think that like the other aspect to MetaDAO, not to like over intellectualize it or compare it to Hyperliquid, is just the counter positioning exercise that it's taking against the previous state of the crypto market. And that could be a fruitful exercise. It's definitely created an early set of loyal users. I'd say there's like 80 to 100 people that are essentially like a cult within the futarchy community. And they generally are like not randoms. Yeah, so I think that like,
100 trillion.
So yeah, I don't know. Maybe I'll stop there. But like in general, like I'm on futarchy.
Okay, there's two things. There's two separate things within MetaDAO. And I guess one question I have is, well, it's not clear to me they're like that related. One, which is a launch pad, effectively. Okay, maybe it has some, like you said. Also, by the way, I've talked to Profit before, so like I have some context, although I think they have changed and or added some, some direction since then. So I haven't followed as closely. With that said, there's this launch pad, basically. Maybe that's a bit of a condescending term, but anyways, there's a launch pad portion of it. And then there's the futarchy component, whereby, and correct me if I'm wrong on any of this, MetaDAO partners with projects, some of them more established. For example, I think Jito, right? Doesn't Jito use MetaDAO? Yes? No? Okay. I'm just making sure, because I couldn't remember if it was Jito or not. I know one of the more established Solana projects. One thing I'm curious about is what is the value, and I'm not saying there's not any, but what is the value of like Jito using MetaDAO versus just doing this in-house? Like, that's one thing I haven't fully understood. What is the value proposition of MetaDAO organizing and facilitating this futarchic component? Why doesn't Jito just do this on Jito's website? Like, what is the MetaDAO aspect of that?
I mean, they could. I think it gets into the question of like a lot of the different decisions that people make to using service providers versus building in-house, like cost to them versus cost to build and cost to maintain. Like ultimately, like the basic mechanism of futarchy is somewhat simple. So you could fork the code, but then the question becomes like, are there going to be continuous iterations that are made by a team dedicated to it that can then like spread out the cost of those innovations across all the teams that are using it? And so like that's the part where it becomes less clear whether you want to build it in-house. And then also like Jito isn't paying ultimately. Like if you want to use MetaDAO, the traders are paying. And so it's no cost to Jito using it. And so yeah, if MetaDAO started charging Jito, I think it's a different conversation. And also I don't think Jito's using it for all governance. I think they've used it for a couple of governance votes. But yeah, I don't necessarily want to like steel man too hard the argument for like why you would build this in-house versus like use MetaDAO, because for this specific thing, it's not like it's making that much money for MetaDAO, so it's not necessarily like a great business opportunity for someone to build in-house. But like there are a bunch of like marginal MetaDAO updates that have occurred that if you fork MetaDAO a year ago, you'd probably have to fork it again. And then it just becomes a question like, is it really worth doing that if it doesn't cost you anything to do? And that like futarchy AM, for example, was one thing necessary to create better liquidity for the like decision markets that were being created. And that was an AMM product that they built in-house. It's not to say you can't just fork that as well, but again, like it's a free product to Jito, and there is product design that continues to occur. So that's kind of my initial inclination as to like why they're not going to just build this in house, but they could. They definitely could.
Yeah. Obviously, I have, as someone who fairly non-technical and had a cynical, view on the ease of launching crypto protocols for quite some time. Like, obviously, I'm very far on the spectrum of like, why don't they just make that like a plugin? That's like my initial thought about everything. Even when there's like some, massive project, I'm like, well, I think Robinhood could just like make that a plugin. You know what I mean? So like, this is why oftentimes I have these, and the fact of the matter is like it's a character defect of mine, but it's because of being hardened for years of looking at crypto stuff and be like, yo, guys, this is not worth what you think it is. I promise you it's not. You know what I mean? So like,
I share the same bias as you.
Yeah.
And so like that's why I think for MetaDAO specifically, it's one of those things where like it still is an early stage company and like it doesn't have the competitive moats that is needed to have like a articulate version as to why they can monetize this specific product without having some question from their users on like buy versus build. But I think that the team's smart enough to understand this dynamic, and that's like partially what informed them going into the launchpad side of things, and that like they can enforce these things on day one, and also they can help companies raise capital, and that is something that people are willing to pay a lot of money for.
Are you excited about prediction markets? Do you have any? I don't know. I'm asking earnestly, like thoughts on prediction markets.
I have like the most consensus take of anybody. I think in that like, on one hand, I hate the marketing that Kalshi has. I find it incredibly offensive. Like I'm on Instagram and I have like these like sponsored ads where they're telling me like, oh, you can gamble on the weather and pay your rent. So like that's like one side of things is that like I dislike the marketing. I think that like right now the majority of the activity is sports gambling. And like I think that everybody is pretending like it's not and throwing a fit that like is an investor in these companies to like explain why they're the future. And like on the same hand, or on the other hand, like I agree that prediction markets are probably going to continue to proliferate and are quite impactful. And like actually do have benefits to like traditional sportsbooks models, and that like they create an exchange versus like you trading against one player. The counter to that is that like Kalshi is taking the other side of all these bets as opposed to like they're being market makers. And
yeah, but also like, I mean, this was the original vision, but now you see taker speed bumps, which is fair. Like, to be clear, if you want deep liquid markets, right? Like you can't have people court siding. And this was a real problem, by the way, with it like early on when sports betting was becoming more popular on prediction markets, like there was a lot of court siding. So, but I mean, that does like some of these preferences for market makers do start to lean toward preferencing a certain group, which in my opinion nullifies some of the peer-to-peer ideas. And the fact of the matter is real market makers don't provide liquidity in markets where they don't have an edge. Like this is and so you can get these little event markets, but in reality, yeah, it's, I don't know. Like the only reason I like started thinking about this is because I remember the Bankless, I remember listening to a Bankless episode about Polymarket, and I thought that some of the like peer-to-peer idea, which sounded so utopian and idealized, is not exactly how it works, and is definitely not how it's going to work in the future if you really do want, market makers and like deep liquidity. So this is a little bit naive, I think, but yeah. I mean,
I agree.
There is lower rake. There should be lower rake. Like if you just think about this at a very simplified level, which in some ways I'm probably thinking about too simplified a level, but like when you have peer-to-peer markets like this, yeah, I mean, Polymarket doesn't charge a fee right now, but we'll see going forward. Maybe on their US app, like probably, they'll monetize in some way. But in any case, yeah, a peer-to-peer market shouldn't have 10%, like 10-cent lines across the board, right? It should be lower than that. We'll see where that converges.
I agree. Yeah, and like I don't think that like you lowered the cost and therefore like this is a groundbreaking up. So like, I'm not even necessarily suggesting that like this is some incredible improvement relative to sports betting today. And like ultimately, I think the value of prediction markets is what the like people that are investing in it are saying. It's just remains to be seen how large of market opportunity that is, and like what gives you have to have in order to like proliferate that market. To your point on like speed bumps, for example, like making markets on a binary option market sounds like the worst thing in the world. I'm not a market maker, but it sounds terrible. I don't see how you really do it effectively.
Right, but I think like some people are printing on those, and then a lot of people, I think a lot of people are getting wrecked. But I like.
Yeah, I mean, like you can make binary option markets when you have like a hedging market. So like the 5 minute markets, like Bitcoin price, I understand. Like you can use options, but like the point is for like making markets on, I don't know, like choose your
Oh yeah. Sorry.
geopolitical events. Like there is no making a market there. There is like a fundamental view that you can have on both sides of the book, but like ultimately there's no real way to like offset your risk. The fact that like these things settle at 0 or 1 is quite dangerous for market makers towards the point of settlement.
For sure. Yeah. Also, the other thing is that there are ways that trading firms obviously express views that don't, like, you could have expressed a view on Trump, right, without betting directly into, and like oil futures, this type of stuff where there's some, I think a lot of the proponents, right, like a lot of the investors are quite keen on how much information this can bring to market. There already are a lot of ways to express these, and like with futures and whatnot. And so, it'll be interesting to see. But
I think you want to like distill down the markets into the most simple forms to express views on. And today, like there are complex ways to express views, but ultimately prediction markets make it very easy to understand the exact bet that you're making. Like the easiest example is like investing in equities. Like we're building out assumptions on all these different dynamics. Maybe I'd prefer just to predict like whether the market is going to grow, as opposed to like market growth plus this company having market share, take rate, etc. And the other thing is like I do think that like conditional markets like Trump BTC through the election are probably going to find product market fit down the line. TBD on like what that's worth. I think like, the $10 billion valuations that Kalshi and Polymarket trade at aren't good. Like they're good exits. They're not good entries. But these are all questions that I have, and I'm not like nearly as informed on like the intricacies of the dynamics versus their investors. But I think that like the markets are very well understood at this point, as far as like the negatives that are clear today, as well as some of like the inaccuracies of views about the upside of the future, but also that some of the views of the future and like the value that this could provide for information to the broader world being, potentially large.
Very good. Well, Noah, always a pleasure. Yeah, thanks for coming on. It's fantastic. What is your Twitter's? Like Noah Trader, I think.
It's Trader Noah.
Trader Noah, sorry. At Trader Noah. And then check out, well, I don't know if you're allowed to market it, but check out Theia. So thanks for having me on.